Welcome to this special discussion for our Strategic Venture Investment Report, where we are diving deep into the trends and forces shaping the future of the venture capital and private markets. So, venture markets don't evolve in isolation. As an asset class rebounds from recent challenges, the upcoming years will be the defining moments, modifying the foundation of VC through the structural shifts, through the technology driven disruptions, and the new models of value creation. This report brings together tactical insights from top investors, LPs, and industry leaders to define what's next. And today I'm joined by Nicolas Sauvage to take his expertise in the corporate venture capital area and bring his voice into this conversation. So, short intro about Nicolas. He's the president of TDK Ventures, the CVC arm of TDK Corporation, with over $350 million in assets under management and 43 investments, including unicorns like Groq, Ascent Elements, and Silicon Box. He has authored numerous articles on corporate venturing, which also includes one for my big book, the Q2 edition in 2024. So thank you for that, Nicolas. He hosts the well-known podcast, Corporate Venturing Insider Podcast, where he invites different CVC executives and talks about all the critical points happening in the CVC business. So in a nutshell, he's the perfect person to track this entire landscape and talk about this evolution. Nicolas, thank you so much for joining in.
Thank you, Rohit, for having me.
So let's dive into this focused conversation. I want to ask you, how do you see this CVC landscape developing in the midterm? And by midterm, I want to mean 5 years. And think of, when you're answering this question, think of the macro factors which are impacting. One, geopolitics, which is currently in the news quite a lot, and also the corporate financial strength, because they being the parent of providing the capital to the CVC units.
I think trying to predict the next 5 years is good to look at the last 5 years. And I think what I've witnessed in the last 5 years is corporate VCs working better with financial VCs, and financial VCs wanting to work more with corporate VCs. That's important because all we do is for entrepreneurs. And if you think about helping entrepreneurs being more successful, you need your cap table, you need your fundraising syndicate, you need your investors to care about you being successful. And corporate VCs can bring superpowers coming from the mothership that financial VCs cannot. And financial VC can bring this financial discipline, this support in the boardroom, maybe connecting with others in the ecosystem. And I feel like once you combine corporate VCs and financial VCs on the cap table, you're supercharging your startup. Okay. So if I think about the last 5 years, what I've noticed is really this better appreciation of each other's between corporate VCs and financial VCs. And if I'm looking at the next 5 years, I think that's going to improve further. Now, I'm not going to sugarcoat it. Not all corporate VCs are born the same, and not all are well designed. I would even say that probably the minority of them are well designed. But I can see that minorities start to become bigger and bigger. And these pockets of good best practices are starting to be shared more widely through GCV, for example, but also on my podcast, Corporate Venturing Insider. We try to share more and more of these best practices so that even people who are joining into the corporate venture landscape, they have so many people willing to help, and there are so many resources online to help them do well. I think you alluded to the short term, what's happening today, and there's a lot of geopolitics playing right now. Yes. And I think some of the geopolitics, it's part of the VC world. You need to be able to make hypotheses about what the future will look like.
True.
And one of the hypotheses could be a change of administration in the US. It could be about what's going to happen between China and the US. It could be about what India is going to take advantage of. It could be about what Singapore is going to take advantage of. You talked about Silicon Box, a unicorn, very fast growing company. They clearly chose super well to be based in Singapore to start, and now they are having a new plant in Italy. So there is a lot of hypotheses you can make about what the geopolitics will look like. I think what's important is to be able to build a portfolio making non-correlated hypotheses about the future.
Okay.
And so if I think about now what we know about today and how we could predict the future, I think we could see that there will be a need for technologies to allow for countries to not rely on materials from abroad. And so if you think about energy and electrification, that's a big trend. I think you should assume that some of the materials that was very easy to access, like lithium and cobalt and so on, may not be easy to access. So that could actually mean that some technologies that help to reduce that reliance on these materials could become really interesting technologies to invest in for the next 5 years.
Okay.
I think there is another element about maybe the change of administration in the US is you can see probably reduced regulations, which would mean potentially more active M&A and IPO opportunities, which means some return of capital to VCs back to LPs, and then you can start to go back into a virtuous circle. And that's true for VCs, but that's also true for CVCs, because when money doesn't come back, at some point corporations start to say, okay, we've been investing, we've been learning, we see the strategic value, but we still want to see some cash back.
Got it. So I want to touch base on a couple of points that you already mentioned. One is the uncorrelated bets. What do you mean by that? Can you expand on that? So what probably you want to say that within a CVC unit as well, you want to have areas in which you invest, which are kind of uncorrelated to kind of diversify your portfolio. Is that correct?
Correct. And I think if you think about a corporate VC, you want to actually do that for two reasons. The first one is financial. As you make a portfolio of bets who are hopefully uncorrelated, you de-risk your portfolio. And that's even more important because we live in a power law type of distributions because we, at least in TDK Ventures, we invest very early stage. So the power law is just a law you have to know is going to happen because it's a high level of uncertainty. So that's the first one. The second one is you want to make sure that the mothership, in our case TDK, gets to learn about many, many aspects of the future. Because our job as an exploration mission at TDK Ventures is to help TDK to know where to go and where not to go in the future, which is a definition of strategy, inside the mega trends that TDK has identified as part of the long-term strategy. And you can do that better if you start to invest in entrepreneurs who are building differentiated futures. Some will work out, some will not work out. And what you want is to have an understanding about why some works out and why some don't work out. And so having this uncorrelated portfolio of bet makes sense for financial purpose, but also from strategic insights about where the future is going to go and not to go.
Got it. So from a long-term perspective, when CVC, as a CVC unit, you follow those trends, you still want to make sure they are kind of uncorrelated. Got it.
That's true for corporate VCs who have an exploration mission. You also have CVCs who have an exploitation mission, where it's about engaging with startups that can leverage your existing platform, your existing services, your existing product. At that point, that's very different. But in that case, it's more about a diversification of use cases, for example, or verticals. But you would still want to diversify sufficiently enough that you have the financial diversification as well as a range of options for your product, your platforms, your services.
And from a geopolitical perspective, you mentioned it's going to play an increasing role, right? Because probably a lot of supply chain ecosystem is being localized in different countries. You know, there's this topics of we want to make our own ecosystems much stronger. And how do you envision TDK or other CVC units playing into this strength of, you know, localization or geopolitics? And how does the next question is how does the mothership, the main kind of the corporate arm, is going to respond to this geopolitical change? And do you see the corporates being strengthened overall to kind of push more capital into CVC units?
First, I think it's important to know that the venture capital discipline requires you to know that you will get your hypothesis of the future wrong many times.
Mm-hmm.
With that means that you can make hypotheses about uncertain and even unlikely future. And this is what some people call contrarian view, because very few people believe in that future.
Mm-hmm.
And so our job is not to predict the future. Our job is to place hypotheses about what the future could look like. And at TDK Ventures, we love to do it from a point of view of what does the ideal future look like?
Mm-hmm.
And then try to backcast from that ideal state of the future,
Mm-hmm.
which could be continuous green energy, like type 1 energy would do with nuclear fusion, or the ideal electrification of your home, like SPAN is doing, for example, or the ideal state of mobility, like with vertical takeoff and landing aircraft, like Autoflight is doing. So you look at what are this ideal state of the future, you backcast to today, and you try to identify the gaps from that ideal future. Then you try to identify if there are entrepreneurs working on these gaps. And the likelihood is quite high that they would. And at that point, our job is to find the king of the hill, whoever we believe could actually create the market leader 5 to 7 years from now. And so our job is not to predict the future, but to make good hypotheses about what that future could look like and identify the entrepreneurs who want to build that better future and support them and learn with them together. And there will be times where the future we have placed a hypothesis about proved not to be correct. But that's okay, because then we learn where not to go. Let me give you a concrete example, because we made an hypothesis at some point that lithium would not have the same easy supply globally as it is in the past. And actually, we are being proven correct right now. And that's what drove our investment in Peak Energy, which is a sodium ion solutions for infrastructure grid. And they don't need lithium. And so you can see their solution is not just good for sustainability, it's actually extremely good for not relying on these materials like lithium for your own supply chain, for your own infrastructures, which, by the way, today becomes even more important given the energy requirements increase due to hyperscalers and the AI and generative AI, exponential or super exponential type of growth. So we need that kind of resilience, and this is why we invested in Peak Energy.
Got it. I love your explanation of how you think about the process of investing at TDK. Loved it. One more question on this corporate angle. So, do you see more corporations launching CVC units, or will they focus on fund-like structure, which a lot of corporates are kind of coming up with these days? So, where do you think this direction of CVC is headed?
Well, I think your question is two parts. One is strategic and one is tactical. The tactical is whether it's direct investments or fund of fund or hybrid. And I think that we could park for a second question, because this is actually full of golden nuggets and full of mistakes. So maybe that we can park for if you're interested. But the strategic element is, should corporations have a corporate VC? And by the way, corporate VC is only one tool of corporate venturing. So you have many, many ways to do corporate venture. But I'll talk about corporate VC. My personal opinion is that as soon as a company is doing well and let's call it $1 billion revenue size, it's hard to believe they cannot afford not to have a CVC. Because the CVC is actually quite inexpensive. It's a profit center. So you should expect the CVC to return more money than it costs you over time. But you need to be patient, because like any VC, it can take 7 to 10 years before it becomes cash returning and cash positive. But it can be a profit center very, very early. TDK Ventures, for example, we've been profitable for the last 4 years. So our financial gain is more than our cost. So there is a way to make corporate VC in a way that is profit and a profit center. And with that, you get an insight about the future if you do it well, like we discussed this uncorrelated portfolio of bets, where you can learn about the future and help the mothership know where to go and where not to go, in the case of an exploration mission, or if you have also an exploitation mission, to go and engage with entrepreneurs who are building solutions that could be a fit for your existing product or platform or services. And so at that point, it becomes like a supercharged business development unit or supercharged strategy unit that helps corporations augment their view about how to build their strategy, short-term, mid-term, and long-term.
Okay. Got it. And so switching kind of gears and talking about the CVC investment specifics, right? Do you see the CVC continue to focus on direct investing in startups, or do you kind of foresee like other elements? As you said, there are multiple ways a corporate can engage with the venture world or the startup world. Do you see the other elements kind of growing, for example, funds, direct acquisitions of startups, and so on? What do you think about that?
So first, I think that corporate VC done well always involve direct investments because you want to have as effective a learning and fast learning loop with the entrepreneurs who are building the future. So a corporate VC who only do fund of fund would have, I would say, good learnings and for good reasons, but would never get that direct access or hardly ever that direct access on a continuous basis, building intimacy with the entrepreneurs who are building the future. Okay. So whether it's 100% or a portion of the investments in direct investments, I think a corporate VC have to do direct investments. But of course, that requires expertise and skills, which may not be available in the corporation today. So there is a challenge there, but I think a corporate VC done well requires direct investments. Okay. Now, what's interesting is that the fund of fund strategy could be a really good way of onboarding a CVC. You're starting a CVC where you engage, and you have to be smart about how you engage with funds, but it could be a really good way for you to learn the job of a VC. Okay. And then really improve your crafts. At some point, you are capable to do direct investments. There are other tactical reasons why you may want to consider fund of fund beyond learning the craft and onboarding. I think the two big categories I would call is one is geographical access. So it may be that you want to invest in a fund in Israel or in India, which allows you to have very quickly access to entrepreneurs locally, to insights about the market. So that I think is a really good rationale for investing in a fund that is in a geography where you have no or limited access. I think the second good reason to consider a fund of fund strategy is for something that you want deep expertise, but you don't have it in your corporation. And it would not be cost effective to build that expertise today. Okay. Let's say you want to learn everything about quantum computing, or you want to learn everything about crypto, or you want to learn about virtual reality and augmented reality, but you don't have that in your corporation. Then that's actually a very cost effective way. Maybe you put $2 or $5 million in a fund, which by the way could return more than what you put in. And you get access to true experts who know about the space and can give you probably within a few months very quality briefings about the space and what you need to know for your corporation. So that's why I was separating the strategic element of having a corporate VC, which I think most companies of 1 billion plus revenues that are doing well cannot afford not to have. And the tactical element of complementing direct investments with fund of fund strategies, which I think are very clear benefits when you're thinking about geographical access or deep domain expertise access.
Got it. I like the way you explain on why fund would make sense and why the traditional CVC makes sense. And so if you just talk about this, the normal CVC units and their direct access or direct investing to startups, how do you see those startups evolving? For example, CVC units, you said you are focused on very early stage investing. Do you see a difference within the CVCs across US and Europe focusing on different stages? Why do they do that? And how do you predict it to change in the future? What it really depends on?
And it's always about the why of your CVC. Okay. So I already mentioned two of the big goals of a CVCs. One is exploitation of the current business and one is exploration. If you're thinking about exploration, which is what we do at TDK Ventures, we're really looking at the best entrepreneurs who want to build the future we want. These gaps we identified from an ideal future that we backcast from. If you have an exploitation mission, that's different. You may actually want to go with the startups that have already an established go-to-market. They have already de-risked the science, the technology, the engineering, and they are already ramping up. At that point, you might imagine that an exploitation mission would look more at Series B or Series C type of startups, while an exploration mission can go all the way to seed. The majority of our investment at TDK Ventures are in seed and Series A.
Okay.
And the reason is we're in an exploration. There is no market yet. We are looking at new market, new technology type of combination. That by definition means it's not going to be a Series E type of company. So we're looking at very early, and I think that makes sense. But there will be time where even with an exploration mission, you may invest in a late stage startup because inside that startup, they are building something new. Maybe it's a pivot, which is actually very early and very uncertain. And that's why at TDK Ventures, we never say deal for an investment. We say project. And word matters. And the reason we call them projects is because this is a live project of the entrepreneurs. While deal is very transactional. And so when we look at investments, we call them early stage projects and not stage, even though the majority, actually, once you have Series B, it's more than 95% of our investments. So we are really early. But we have made, I think, 2 exceptions where it was late stage, but these 2 late stage companies were having very early stage projects inside their company. So that's why sometimes it makes sense to think about it from an exploration mission versus exploitation. And from a geographical difference, I think maybe there is an aptitude element. You should argue that venture capital is all about risk-adjusted pricing. So you should set a valuation that commensurate to the risk you're taking. And it's very hard because you need to have these 2 thoughts at the same time in your mind. The first one is how big can it get, even if it's a very small probability? And what would it take to get to that amazing 50 times or 100 times your money? Okay, a really big outcome. And then you need to think about all the things that can go wrong and that could kill the company. And that's typically more than 50% of the probability, especially at seed and even Series A. But that's important because it means that you have to think about all the mitigation points which you could bring. And as a corporate VC, we can bring with our superpower from the mothership to help the company not to die, and then make sure that we help them to get to this maximum outcome and be very, very successful. And if you have this discipline of thinking about all the things that can go wrong and how high the outcome could get if it's very successful, you're going to do well with a power law type of distribution of outcomes. Which is, by the way, so counter to the way a corporation thinks. And I wrote a Medium article about what you need to unlearn from a corporation to do corporate VC. Because in corporation, your outcomes are distributed through a distribution law, which means that most of the outcomes are good. Some, few, are not good, and some are very good. But you don't have a power law type of outcome. And the reason is you're making decisions from exploitation of a business you really know. The uncertainty level is way less than it was. And as a consequence, the way you make decisions is different. Typically in corporations, you follow whoever has the most experience, or you go with consensus. That works really well with that type of distribution of outcomes. But when you're talking about power law, this is very, very different.
Got it. And very briefly, from a geographical perspective, Asia versus Europe versus the US, where do you see the most CVC activity and where do you see the most growth that is going to happen within the CVC space, and why?
I think, again, we should think about it 5 years from now. But I am bullish on US. I am hopeful in Europe. I am curious about China. I am bullish about India and Singapore.
Got it.
And India is very interesting. And we have a team that is growing in India. We've made 3 investments and looking to make more this year. This is a place where, I mean, you know the term jugad, which is really about being innovative despite constraints, which in a way is the definition of an entrepreneur. You start with so many constraints and you have to innovate your way into success. And what I find very interesting in the last 5 years in India is that it used to have the best talent leaving India to go to the US, for example. Mm-hmm. Now, the best talent stays in India, and they even join startups, which in the past was something when you were young in your career, you could not do that. Your parents probably would not like it. Now it's totally accepted and it's actually respected. And so I'm actually bullish on India because I see an opportunity for entrepreneurs to do really, really well in India, where it's highly constrained, but then be successful outside India on a global basis. And to look back to your question about corporate VCs, I think corporate VCs can play such a big role in India, both to provide a superpower to de-risk, in our case, deep tech technology, provide an early go-to-market, but also provide a pathway to a global success. And I think this is what I'm hoping to do with our team in India, is to help local entrepreneurs who want to have massive contribution to society to be successful in India and then go beyond.
Super interesting take. I know the time is running out. I would quickly want your take on one critical point. So the VC ecosystem, there were last couple of years, there was a pullback from the VCs who wanted to invest. And CVC on the other hand side kept on investing because there's corporates and corporates are in general doing well, relatively well, at least in the Europe, at least in the US. So from that perspective, where do you see the gaps where CVC can actually win rather than the VC?
So I think it's important to understand 2 things. One is that corporate VCs are very fragile at an individual unit point of view. Mm-hmm. We see many corporate VCs stopping over time. But what I believe is that as an ecosystem, as a whole, it's extremely resilient. It's extremely patient and is capable to help entrepreneurs with way more superpowers than the financial VCs. Okay. And so the way I like to think about it is there's no doubt in my mind that a corporate VC done badly is much worse than a financial VC done badly from the entrepreneur point of view. But I'm also convinced that the best corporate VCs, because of their inherent superpowers coming from the mothership, can bring even more value than the very best financial VCs. And so the question is, how do you make sure that this corporate VC as an ecosystem keep raising the bar so that more and more of the corporate VCs start to be exceptional and fewer of the corporate VCs do poorly? And I do not believe for a second that people start a corporate VC saying, I want to be a bad corporate VC. No one starts like this. Yes. But what's happening is that many people start a corporate VC with very little coaching or mentoring or support. And that's why I'm so grateful to GCV, because they've been helping me learn the craft. And I've had amazing mentors like Paul Holland and Pete Moran helping me the craft of venture capital. And I want to give that back and pay forward with all of the podcast interviews where I'm asking questions like you're asking me today. I'm asking questions to practitioners so that we don't no longer have pockets of best practices which are shared only between people who know each other. It becomes really democratized. And one region I haven't mentioned, I mean, there are many regions where I think there is huge potential for disruptions and amazing entrepreneurs, which is Brazil and South America and Africa. And I think these regions are going to leverage the democratization of best practices as well as the access to much lower cost tools, whether it's generative AI, blockchain, Web3. There's a number of technologies that allows these entrepreneurs, regardless of where they are. And with the compute cost reducing, we invested in Groq, for example, in 2020, early 2020. And Jonathan Ross, the CEO at the time, what I loved when I interviewed him to decide to invest or not was he wanted to make the cost of compute zero.
Okay. Wow.
If it does that, it gives an ability for everyone to have access to compute.
True.
And what's amazing is that it's proving its model is going to work.
True. Amazing. Nicholas, thanks for joining us, telling us a lot about the strategic view of CVC and how it would look like in the future. How should other corporations should think about starting their own units and all in between. Thank you again for taking part.
Rohit, and I was quite excited. I couldn't choose my typical Zoom background because I like my background where it has all the portfolio companies we invest, 43 of them today.
Okay.
At least I could choose one which has a cassette like a TDK cassette. So that was nice.
Thanks, Nicholas.